After 60 years of running the Berkshire Hathaway investment portfolio, Warren Buffett is officially stepping back as CEO of Berkshire Hathaway. Now, I know what you're thinking. Maybe this is a cause for concern. In this episode of the podcast, you're going to find out if 3 of Warren Buffett's biggest shareholdings are undervalued, fairly valued, or maybe overvalued. We're going to talk about Apple, Coca-Cola, and American Express. And we're going to take you through exactly what Warren Buffett looks at when he is building a portfolio. And I'm going to introduce you to a fantastic tool to track investing gurus just like Warren Buffett. This episode of the podcast is proudly brought to you by TIKR. That's TIKR. I couldn't tell you the last time I logged into my brokerage account to try and find company data like revenue, forecasts, profit, all those types of things. I simply don't do it anymore because I use the TIKR terminal instead. It includes analyst transcripts, all these valuations that we're going to do today, and so much more. If you are watching along, you'll be able to see exactly what I'm doing with the TIKR terminal. And if you're listening, you can dive into the description in your podcast player or in your YouTube description to find the link and take it for a spin yourself. In the United States, big professional investors like Warren Buffett and many others are required to give us a hint or to tell us exactly what they've been up to recently with their investments. In a system known as 13F reporting, what these big investors have to do is tell investors what securities or what shares they have been buying every quarter. It's kind of like a quarterly scorecard on the biggest investors in the United States, including Warren Buffett. So we can actually get a glimpse into what they're buying and selling. Now, it doesn't include everything. When you observe a 13F, it typically only includes securities or shares that are from the United States. In the case of Warren Buffett, we know that he has investments right around the world. But thanks to the TIKR terminal, we can get a really good glimpse at so many different pieces of the puzzle that make up the Buffett portfolio. What we can see recently, for example, inside the TIKR terminal, is that Warren Buffett has been selling his Apple stock. He most recently sold 20 million shares of Apple. Fortunately, he still owns 280 million shares worth a cool $58 billion. He's also been selling Bank of America shares. He's sold 26 million shares, and he's now got about $28 billion invested. So about half of what he's got in Apple. We'll take a look at the Apple valuation in just a moment so you can get a sense of maybe why he's made that decision. I won't give too much away right now. Inside his portfolio, we can also see, and if I just list them out in order, Apple, American Express, Bank of America, Coca-Cola, Chevron, Moody's, Occidental Petroleum, Kraft Heinz, Chubb, Mitsubishi. One of those companies, that is Mitsubishi, he has been buying recently. You probably know the name Mitsubishi from appliances or electrics that might be in and around your home or place of work. If we step back a moment and we think about why are we actually talking about Warren Buffett, I think it's worth reminding ourselves just how good this investor is. Over 60 years, Buffett has produced an annualized return on average of 19.9%. Some people say that there may be other investors in the world that should be considered the best. But if you take a 60-year track record and you compound it at 19.9%, I believe there is no one even close to Warren Buffett. In shorter time horizons, quantitative investors such as Jim Simons of Renaissance Technologies probably has a better track record, with the rumor being that his fund returned over 30% over more than 20 years. So on a shorter term horizon, maybe Jim Simons holds that track record. But over a 60-year period, Buffett is undoubtedly the best investor the world has ever seen. Buffett has turned the textile business of Berkshire Hathaway into a $1.2 trillion behemoth. He's done that, as he first revealed, predominantly through buying listed companies. And he has this process, which he first laid out in 1977. This is the first time that I've actually seen or read where Buffett fully disclosed the process he uses to find stocks to buy. Buffett outlined his 4 criteria. Number 1, an understandable business. You'll often hear him talk about this idea of a circle of competence. Number 2, favorable long-term economics. Most investors now call this unit economics. This is the idea of basically understanding exactly how much profit is made from a business every time another sale goes into it. Think about it like the Kraft Heinz business. Buffett has often quipped that he looks for businesses that import commodities and export a really valuable product. At home in my pantry, I can tell you with certainty that there is some Kraft Heinz baked beans. What this business actually does, if you think about it, is get beans from around the world, just those beans that you know and love in your baked beans, maybe you have it for breakfast or on toast, and then wrap a Heinz label around it and sell it in supermarkets for more than the beans cost. So it's taking a product that is commoditized, the beans, and selling them with a Heinz label, something that he can control. So you can see a wonderful business with fantastic economics. The next thing that Buffett looks for is trustworthy and able management. Charlie Munger, Buffett's sidekick, did so much work on this with Warren Buffett, trying to tell him and to educate the investing world of the importance of good management teams. The fourth and final thing that appeared on Buffett's 1977 annual letter as a criteria he looks for is a reasonable valuation. Having tracked the work of Warren Buffett for many decades now, I can tell you with certainty that over time, Buffett's focus and emphasis on valuation seems to have lessened. That means in the beginning, he was a real die-hard value investor. His mentor, Benjamin Graham, the author of Security Analysis, was often looking for cigar butts. But what Buffett realized through Benjamin Graham, but also through Charlie Munger's influence, is that it's better to buy a wonderful business at a good price than a good business at a wonderful price, because wonderful businesses will compound for decades to come, kind of like See's Candy, which is a long-time Buffett holding. Before we dive into Buffett's portfolio and do some valuation work for ourselves, I want to just quickly talk about two more things. Number one is the time it takes to find the types of companies that Buffett has invested in throughout his life. When it comes to Benjamin Graham, that is Warren Buffett's mentor, there has been a lot of talk about exactly how Benjamin Graham became such a great investor. And what the data seems to suggest is that by far the single best investment that Ben Graham ever made was an investment in Geico, the insurance company. Despite lecturing and writing for decades about the importance of valuation, Ben Graham effectively broke all of his rules to invest in Geico, which then transformed his investment track record and made him one of the most notable investors in history. He chose a business that was of wonderful quality, but maybe didn't have the valuation criteria front of mind. But what was especially interesting about this when I dug into it is when I went back in time, I dug up an article that Warren Buffett had wrote titled "The Security I Like Best" for the Commercial and Financial Chronicle in 1951. The article actually contains a young photo of Warren Buffett, or a young looking photo of Warren Buffett, and he outlines the case for Geico. What I took from this article, however, was that it actually took Buffett 10 years to settle on the idea of buying Geico. Despite his mentor, the person that he learned probably the most from in his life, buying Geico, Buffett still took 10 years to finally getting around to buying and holding it, which he still does today. The second thing I want to talk to you about is not just the patience involved in researching a company, but also the patience involved in buying and holding onto a company. Buffett first bought shares when he was 11 years old. He then went on and had pinball machine businesses and so much more. By age 30, Buffett was worth nearly $1 million. And by 60, he was worth many billions of dollars. Today, Buffett is worth over 140 billion US dollars. What this math tells us, if you stare at it long enough, is that after the age of 60, Buffett made more than 99% of his wealth. So, in the first, say, 50 years of his life, Buffett made less than 1% of his wealth. And then after that, later in life, he made over 99%. And here's the thing. It's not because he worked harder. Buffett didn't work 99% harder after the age of 60, I can tell you that. It's actually because he let the power of compounding do the heavy lifting for him. In the early days of his life, he worked really hard through newspaper runs and private businesses that enabled him to accumulate cash to invest. It was after a few decades, however, that the investment returns became the most important driver of his overall results. And that's what has made him a wonderful investor today. Not that he could invest at high returns when he had small amounts of money, but that he could invest at high rates of return when he had billions and billions of dollars at his disposal. This isn't always apparent to most people, but Warren Buffett invested huge sums of money in the depths of the GFC. In fact, some people would say that Buffett's investment in Goldman Sachs, right when other investment banks were going bust, was one of the catalysts for people to renew their optimism and start investing in the share market again. That is an example of an investor who has billions of dollars at their disposal, can then act with conviction and get those returns we're talking about today. So now that we've been through the case for Warren Buffett, let's jump into his portfolio and do some valuations in the ticker terminal. As you can see in his portfolio, Apple is the biggest position, but he's also trimmed it recently. So let's ask ourselves why that might be the case by doing a quick valuation of the Apple business. If we jump into the Apple screen, we can then go to valuations and click on valuation model and we'll create one. I'll call this Apple-Berkshire. Now, if you're watching along, I'll put in some numbers, but if you're listening, you'll be able to play along as well because I'll explain what these numbers mean. There are 3 questions we have to answer inside the ticker terminal to get a simple but effective valuation. Number 1 is, how much do you expect revenues to grow per year through 2028? We can see here that the ticker terminal has prompted us. Over the last 15 years, Apple has grown its revenue at 17% per year. Over the last 10, it's 8%. 5, 8%. Over 3, 2%. Apple's revenue looks to be slowing. So it's still producing billions of dollars of revenue. It's still selling lots of iPhones, but predominantly the reason that its revenue might be slowing, but the business is still valuable, is because the mix of revenue is shifting towards services. That is, people buying from Apple based on its software, not based on how many units or hardware it can make. So we'll see the implications of that in just a moment. I'm going to choose a figure of approximately 4% revenue growth per year because I still think the business will grow and it should still beat inflation, even though it's a giant business. Number 2, what do you expect operating margins to average throughout the period to 2028? So the operating margins or EBIT margins tell you how profitable a business is. Over the last 1 year, it's 31%. 3 years, it's 30%. Over the last 10 years, Apple's profitability has been about 28% of revenue. I'm going to assume that the business has got more profitable through time, and we can see this playing out recently. We can see the margins improving as Apple's revenue shifts from that hardware that's made in China and designed in California across to things like iCloud, subscriptions, arcade, and so on. Let's say the profit margins go to 32% on average. Our final question that we have to ask ourselves is, what do we think the PE multiple, the valuation roughly, will be when the stock is sold in late 2027. Over the last 5 years, Apple's PE ratio has averaged 28 times. Over 10 years, it's been 21 times. Over 3 years, it's been 28 times. Let's go 25 times profit multiple and generate some results. Here, we can see that Apple's business is mildly overvalued based on these forecasts. So assuming our expectations are delivered, what we're suggesting here is the Apple share price is actually a little bit expensive. Maybe, just maybe, that explains why some of these shares are being sold by Berkshire and redeployed in other businesses. Now, we'll just exit that now and we'll let that save in the ticker terminal. We'll come back to it. Let's go to another company. Let's go to the second biggest position in American Express. American Express is a wonderful business. When you log into the ticker terminal, or when I log in here, you can see that I've already got a valuation for American Express. That's because I want to buy some shares, and I've been looking at the business for quite some time. But we'll do another thing. We'll call it Amex Berkshire. In our model, we'll do another valuation. If you don't know Amex, it does credit, debit cards, and it does kind of cash flow services for businesses right around the world. What's amazing about American Express is it actually has a closed loop network, meaning that it controls the full payment system from bank to customer. It controls the full system, and that's what makes it incredibly valuable. In addition to pretty much owning the really valuable demographic of higher income individuals who, for better or for worse, kind of use the Amex business and the Amex logo as a sense of pride, even though the interest on the cards are pretty high. So how much do you expect revenues to grow at Amex? Well, we can see over the last 3 years, it's 16%. Over 5 years, it's 8%. Over 10 years, it's 7%. The Amex business is actually getting more valuable as more customers gravitate towards its tools and businesses start to use it. I know our business uses it now. So I'm going to be a bit more bullish with this. I'm going to say revenue grows, let's say about 14% per annum over the next few years. What do we expect operating margins to be? They've averaged about 25%. I'm going to go 27, which is in line with the latest year's worth of results. What do you expect the price earnings multiple to be? Like Visa and MasterCard, I think this business is super high quality and deserves the premium price tag. And I think other investors will do that too. I would suggest that the PE ratio hovers around about 18 times throughout that period. Let's get some results on our quick and simple valuation. Based on the valuation inputs that I've put into the Amex, we can see that over the next few years, based on our assumptions, assuming they're all correct, which is not always the case, we can see that it looks like the business is approximately 19% undervalued per annum. So what we're suggesting here, what the ticker terminal is suggesting, is that based on the expected results, the business could compound from here at 19% per year in returns. Or to put it more simply, 51% undervalued. That sounds pretty compelling. But of course, this is just a simple valuation. You can also do a more advanced valuation before buying shares in a business like Amex. All right, let's go back and do one final valuation, and then we'll kind of take stock of where we're at in Warren Buffett's portfolio. Let's say that we do Coca-Cola. Now, you can't see it, but just here off the screen, to get me ready for today's episode, I actually had a Coke Zero. It's kind of my go-to, kind of like Warren Buffett with the annual meetings that he would do. It gets me up and about for these podcast episodes that I record. So let's do a quick valuation of KO, that's the Coca-Cola ticker symbol over there in the United States, and we'll call it KO Berkshire. So we'll do this quick valuation again, and for people listening, I'll walk you through it. Over the last 10 years, Coca-Cola has grown its revenue at 0% per annum. Over the last 5 years, it's gone up approximately 4.7%. So really modest growth over the long term. It's kind of plateauing. So I'm going to keep it in line with that and just say it grows. Maybe I'll be 1.5%. Assume it's growing, but not that quickly. It's facing a lot of competition from Pepsi, but they're both good businesses and you could buy them both. What do you expect the operating margins to be over this time? Over the last 5 years, it's averaged 29% in operating margins, so that's what I'll go with. Number 2, what do you expect operating margins to be? Over the last 5 years, operating margins have averaged 29%, so I'm going to go with that. Number 3, what do you expect the PE multiple to be when you sell the stock? I'm going to say it's around about 23 times, in line with most of the historical standards. And the reason I'm saying that is because Coca-Cola actually, by US standards, pays a decent dividend. Using all of these assumptions, the Coca-Cola valuation comes out to be 0.9% expected return over the next 2.4 years. So as you can see, it's probably not the type of business that you would say is deeply undervalued at any one time. So what I'm going to do now is actually show you, once you've done these valuations, how seriously powerful the ticker terminal can be to your ongoing valuation work and your ongoing investing. If I jump quickly to the valuation model hub, you can see here that I've got a heap of different company valuations. So when I used to train analysts to invest, and when I still do teach the Value Investor program, I'm a huge fan of doing your own valuation work in spreadsheets. If you're new to investing, you've got to understand the rules of the game before you can play it. And I think doing a valuation from scratch is the absolute essential step that you have to take in order to understand exactly how TIKR and these types of tools are building these valuations. That said, as an investor today myself, I can produce really good valuation models. And by that, I mean kind of the multiple-based valuation models like PE ratios, price to sales, and that sort of a thing. Right here inside TIKR, you can see that I can do them in probably 15 or 20 minutes. I've often said that the best thing for investors to do is to remember that valuation is only the very end of what your kind of overall research process has to be. If I had a week to research a company, I would spend 4.5 days researching the business, and then the last half a day jumping in here to TIKR and actually tinkering around with the different valuation tools and the different scenarios that I could run. But let's take stock of what we've got here in front of you. We can see all of the companies that I've done a valuation from or on here in the ticker terminal. I've got Bank of America, Apple, Coke, Intuitive Surgical, American Express, Costco, CVX, Moody's, Wesfarmers here in Australia, Pro Medicus here in Australia, and Tesla. What you could do is you could map the entire Berkshire portfolio and do your own valuations. But with the click of a literal button, you can click on this estimated return and rank the companies that you're currently watching by your valuation. So effectively, you're ranking the companies by what you expect them to return over the next few years with the click of a finger. So if you're looking, for example, to deploy money into a part of your portfolio into companies that you've been watchlist for a while, you don't really miss anything because it's right here in front of you. You can actually just bang, click, and it's done. This is very different to when, even 5 years ago when I was teaching analysts to invest and running a team of analysts. We would have to maintain our own valuation screens and our own valuations in giant Google spreadsheets or even in, Excel spreadsheets and that sort of thing. But here we can maintain at least simple valuations or more advanced valuations across different time horizons inside the TIKR terminal. So as we come to the end of today's podcast episode, let's just recap. The secret sauce of Buffett's investing is the simplicity and the patience involved. After 60 years, he's taught us that it's important to keep it simple, focus on the quality of a business, and use repeatable processes to really filter out the companies that you want to buy. You can also then be extremely patient in when you buy different companies. You don't have to rush in. You don't have to swing at every pitch that gets thrown at you. You can take your time and really find those companies that have great unit economics and compounding potential. If you like this episode of the podcast, I really enjoyed doing it and I want you to tell me about it because then I can do a lot more. We can dive into individual companies, do full deep dives on valuations, get guests on the show to help me with these short episodes and so forth. Let me know in the YouTube comments or if you're listening on Spotify or write into us on the Rask community or via the link in your podcast player. It says, ask a question and leave a note for me and just say, hey Owen, love the show. Would you mind taking a look at ... whatever company you might want us to take a look at. I'd love to jump into it and hear more from you. Thanks for listening to this episode of the podcast brought to you by the TIKR Terminal. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.